Hello everyone. So today is our second webinar on TradeClue. The most important part, since the markets are very volatile, market keeps opening gap up and gap down. So today's topic is very much interesting. How to trade gaps, right? And this is very interesting topic because apart from huge gap up, gap down, normal gap up, gap downs can also be traded very wisely and very easily. So before we start with gaps, I would like to introduce the technical levels. Now, what do you mean by technical levels? And there are other levels called as option levels. When you start with technical levels, we are talking about support and resistance. And you have options level, we talk about OI or we talk about max pain. Those are the levels from option side. So when we go out and see TradeClue, so on the TradeClue front end, you will have the chart. You're trying to see 5 minutes, 15 minutes, 20 minutes, whichever charts you are trying to look on. The agenda over here is to see the lines which are given on the chart. Right now, sudden huge gap up or gap down will obviously the technical levels do not work most of the time, but more or so if I try to see which are these levels. So if you see on the right hand side, you have some levels called as MS, WS, which is called weekly, monthly support. DS and DR are called as daily support and resistance. So before the market started today with the gap down, but you have some daily support and daily resistance. Okay, and apart from this day resistance or day support, you also have weekly support resistance and monthly support resistance. So these lines which are there are basically called as technical levels. And when you see on the left hand side, you have max call OI, max put OI, right, of the option chain, which is also being plotted on the chart. So idea here is to have technical levels and have options level on the same chart. Now let's understand why these levels are there and how we can use them in the gap theory purpose to make good trade setups. Okay, so let's start first, and I have some examples also which I'll share at the end. The agenda is to have technical levels and option levels. In the options level, you have max call or max put OI. This is fine. When we are trying to see technical levels of support and resistance, the most important point is yesterday close. From yesterday close, you get two lines. One is called DR, daily resistance. Other is called daily support. So these two lines are basically small support and resistance during the day. After daily resistance and support, you have a bigger line called as weekly resistance or weekly support. And below that, you have something called as monthly support, and upper way, you will have something called as monthly resistance. So what is happening over here in the technical levels, the most important point where you are trying to take a trade, if the price goes up, it can first meet daily resistance. Now it's very easy for him to cross and go to weekly resistance. It's also easy for him to cross and go to monthly resistance. In the same way, the same stuff can happen on the support. The idea is, over here, what should I do? Should I look for a bounce or should I look for the next stop from point A to point B? Should I look for a bounce or should I look for the next stop point A to point B? This is what we are trying to address today. So what I'm trying to say, first thing to understand or know is called yesterday's close. Okay, when you know the yesterday's close, you will have all the lines above called as resistance, all the lines below are called as support. Now let's start with the gap. What do we mean by gap? Gap is nothing but this is your yesterday close, and now you can have the index or market opening gap up or opening gap down. So if market opens gap up, if the market opens gap down. So normally this is what is seen. After opening gap up and gap down, now there are various cases. In the sense, if it opens gap up, it can fly. If it opens gap up, it can come back down. Same way, if it is opening gap down, it can go up, or if it is opening gap down, it can go down. So we have now 4 cases, and we want to know how to trade each of them, right? Stock opening gap up or stock opening gap down, and then what is the aftermath? What is the after effect? Can I take a trade for upside, or should I take a trade for downside? Same way, if the stock or index opens gap up, should I take a trade for upside, or should I take a trade for downside? So before you start with gap up or gap down, we now know that these are 4 cases. So I can say I can have 4 trading setup, out of which A over here and D over here. A is opening, zooming up. So it is opening up and zooming up, opening down and zooming down. So A and D are nothing but called as trend. They keep going in the same direction where the gap is being opened. The other two, where we are trying to see D and C, they open but then they come down, meeting to yesterday's close or maybe even below this, opening below, coming back to yesterday close. So in both of these cases are nothing but kind of reverse. The most important point is to understand, will I trade A and D, or will I trade B and C? So when the gap is formed, gap is normally formed at the open. We need to now decide, should I trade trend or should I trade reversal? You cannot be in both minds to make the trade. So please understand, you need to be clear, you want to trade trend or you want to trade reversal. And then accordingly, we need to take action. So let's understand how to know, should we trade trend or should we trade reversal? Whenever we try to see gap openings, you need to first understand trend or reversal. For that, we are trying to see gap. When you're trying to see gap, let's take case 1 called as gap up. That is very clear. If the yesterday close is somewhere over here, the stock opens gap up. Okay, now as we know, trend can take place or reversal can take place. So it can go high or it can go down. First thing to understand is how much is the gap, right? So if you quantify 1%, 2%, 3%, it does not work like that, because every stock volatility is different. Okay, so large cap stocks, mid cap stocks, things are different. So do not try to quantify this gap. What we will do, if the stock opens, we will try to see where it is opening. So if I see now the stock is open over here, let's see if it has opened over here, it has a resistance called as DR. Yesterday close, this is your resistance. If the stock is opening somewhere in between this, that clearly means it has more room for upside. This is case 1. If stock opens straight over here, that means it has opened way too much on the upside, straight at the resistance point. Let's say there is one more max call OI. That means more resistance is there over here. If the stock opens gap up straight to some weekly resistance, huge gap up has happened. So how to react at point A, at point B, at point C? So this is the key. How to react at A, B, and C. So the first instance, when the market opens with the gap up, the first instance is to know where it has opened, so that I'm mentally now prepared what I need to do. If it opens over here, I know it has chance of up and down both. But if it opens up over here, that means straight into resistance zone, likeliness of downside is higher. Straight opening at WR, more is the chances of downside. So I need to now decide at A, will I trade trend or reversal? Will I buy for this or sell for this? So should I trade trend or reversal? If the stock opens straight at DR, should I trade trend or reversal? Trend means further going to WR, or it's going down towards yesterday's close. If it straight opens somewhere over here, here or here in the weekly resistance zone or monthly resistance zone, likeliness of reversal is more compared to upside. So this is where you need to understand moment the price opens, where it has opened. Okay, so this is first key to understand over here. If it is opening at A, we are confused. If it is opening at B, mentally we are prepared, it is in the resistance zone, likeliness is downside. Resistance zone likeliness is downside. So I'm not saying that it cannot go up, it can go up, right? But we are very clear, this confusion is there, this clarity is there, that kind of reversal can take place. If it sustains above DR, upside can happen, and at this huge upside, it can go up and then it starts going down, right? So we have A, B, and C cases of gap up. Now, when you have these three cases of gap up, the B and C case is very easy to trade. How? So let's finish off B and C and then come back to A. When the stock opens at the resistance zone, straight up over here, usually gap up, chances are it can go down. So when it opens over here, let's see on 5-minute chart, if it sustains above DR, it has more likeliness of zooming higher. If it opens over here, does some time pass and then it sustains below DR, it has likeliness of going down. So what are we trying to see? When you see the 5-minute chart, let's say 4-5 candles over here, or if you see 3-4 candles, that is roughly around 15 to 20 minutes of the opening of the market, and then you decide whether things are going down or whether things are going up. So we will know whether it is sustaining above DR or below DR. And if that happens, and if you have a max call OI also over here, one more level is there, and if it is sustaining above this, now we know max call OI is there, unwinding might take place and it can go sharply on the upside. So this is where the trade clue levels help you, where you know where the stock has opened and what kind of action I should take. Okay, and things are very tricky. You cannot apply the same logic over here, the B logic over here. Things are different. If it supports above DR, zooms up. If it doesn't support above DR, starts going down, it will go further down, approaching to yesterday's close. Let's talk about C. When it comes towards C, the agenda is again clear. Higher resistance zone doesn't go above this, chances are on the downside. And then if it sustains above this, chances are more on the upside. Now, when I try to see A, B, and C, at point B, two things are possible. Where it can go up, calling as trend, it can go down, calling it as reversal. Other way around, if it is opening at C, if you try to take a trend trade over here, please understand, it has opened hugely gap up. So I would like to go for reversal trade over here. So when there are huge gap up or huge gap down, try to go for a reversal trade. That's more likely. So if it goes up, goes sideways, makes a spike or something like that as a morning star pattern or kind of engulfing pattern, and then it starts going down, go for reversal setup. So you know stock is open way too much, it might come back down. Second case, going up over here sustains, it will go up. Going down sustains below DR, it can go down. So at DR, we are anticipating both trades. At WR or usually upside, we are only anticipating reversal. Same if you give a chance for this point where it is midway between DR and yesterday close. This is where things are tricky. People should trade gap at B and C because clarity is more. But when you start trading at A, you need to have very good command as to what you are trying to do. So let us understand at A. At B and C, now clarity is there. Usually gap up, we try to look for reversal. Opening at DR, at some point it can go further up, it can come down as well. So kind of trading both trend and reversal. Coming to point A, at point A, you can have both, but the problem here is he is neither in the resistance zone, he is neither near yesterday's close. Now, yesterday close, they act like support. when the stock opens gap up. So when the stock opens gap up, it will act like support. That means it opens gap up, comes back down. It doesn't go one way down. It might bounce a bit and then go down. So there are two ways now to make the trade. If you are at point A. So point B, point C, much clarity is there. Point B opening at DR can zoom up if it sustains above DR. Not sustaining above DR, sustaining below DR, it will zoom down. Hugely gap up around weekly or monthly resistance zone, it will come down. Okay, so your reversal, trend or reversal, let's understand now midway opening between these 2 points. What should we do when a small gap up happens? Now please understand, huge gap up, huge gap down, very rare, right? Out of 240 trading days, it might be 1 or 2 times or 4 times that index might open huge 3%, 4% up or down. Most of the time, it is within this range. It either opens at DR or it opens midway of DR and yesterday close. So whenever it opens above, gap up, yesterday close is the line which will act like support. If the price starts falling down after gap up, this will act like support. Okay, so this is very, very important. Now let's get much deeper into this section where a small gap up has happened. When a small gap up has happened, we need to bring in important parameters. If it is over here, and now we know that system given daily resistance is over here. When it is no clarity zone in between, bring in yesterday's high, yesterday's low. Now why we are bringing yesterday's high and yesterday's low over here? When you bring in yesterday's high and low, when things are opening in the midway, there is confusion, let's bring in yesterday's high. Suddenly, if I see that yesterday's high is over here, or let's say 2-day high is over here, what does this mean? If the stock is opened hugely up over here, not very high at DR, in midway, in this zone, this will act like your resistance. So the yesterday's range will act like resistance. So you need to find whether some resistance line is there or not. If it is not there, do not trade gap. If yesterday's high is not here, if yesterday's 2-day high is not here, if DR is not here, it is just in midway, do not do anything. So if it is over here, now we are very clear. If yesterday's high is over here, stock is opened around that zone, 2 things can happen. Same what we were looking for DR, it can come down or it can go up. Okay, so where the clarity, where midway openings are happening, try to bring in yesterday's parameter. So things become much more rational. Now, if I tell you that yesterday's high is over here, stock opening here, that is again in the midway of yesterday's high and yesterday's low. Yesterday close is somewhere over here, not even over here. Now this stock starts zooming higher, comes back down, zooming higher, sustains above yesterday's high. Then it has more likeliness to approach to DR. Now if the distance is less and you try to buy and the risk reward is not there, don't buy. Okay, we tend to avoid that. But if instead of going up, going up, going up, then it starts going down. This was the opening point. It has now started going down. Then we try to look for a sell trade, keeping this as our stop loss. So this was the level given by the system, and now we brought in a new level called as yesterday's parameter if there is confusion. Okay, if there is confusion, they act as a very good resistance or support. Now, when I'm trying to see this over here as yesterday's close, price goes, doesn't go, doesn't go, doesn't go, and then suddenly the opening point is being breached, we should sell. Now we know over here, when we sell, this will act like support. Why? Because it is acting like yesterday's close, it will act like support, and once this is breached, it can go further downside. Now many times it can act like support and again bounce back. So the agenda should be take a trade, keep a stop loss, do not square off here. wait in the position and look for bigger downside. So risk reward should be more to take these trades. So it started out as a confusion point, went up to yesterday's high, which acted like my resistance zone, did not go up, did not go up, breached on the downside. I took a trade, keeping this as stop loss, further going down. Let's talk about the second case. The second case where again the price opens in the nowhere land. So if I now say this is yesterday's close and we have the daily resistance little bit on the higher side, stock opens gap up over here. The price comes down, sustains on yesterday's high. You can take the trade to DR, sustains DR, you can go for the next level on the upside. So what's happening over here? When it opens nowhere, so either it may not breach and go down because of this yesterday's high phenomena. If it opens above yesterday's high, comes back down, then this will act like support. Many times in Nifty, whenever Nifty opens or Bank Nifty opens gap up, and if it takes support at yesterday's high, it will zoom up. So 90% of the time, these cases are observed where it opens gap up, nowhere land between yesterday close and DR. What should I do? I don't know. Then it opens up and sustains above yesterday's high. Chances are more bright for upside. Okay, so this acts as a very good pointer. Now we need to bring him in only if prices are opening at these points. If prices are opening straight at DR, we already have DR to guide us. If prices are opening straight at WR, we already have point to guide us. So the most important point, I call this confusion opening as near yesterday close. So we can now say in the gap, we have different formations. If the market is opening or stock is opening gap up, you can have case 1 as yesterday close and DR in between. Okay, so case 1, I can say opening near yesterday's high, right? Because in between means you're trying to bring in yesterday's high. Case 2, opening at DR, daily resistance zone, straight opening in that zone, and 3 is weekly resistance, monthly resistance, or you can also bring in options level. If you have resistance at those points when the stocks are opening gap up or gap down, and then you decide to take a trade after small concession zone, those trades will go right? Taking a trade where it has opened somewhere and it's going up and just trying to get into this trade will be very, very difficult to pull the trade. So always wait for some level or line to come, either yesterday high if things are way too beyond and it is opening somewhere in between. And if it is not opening in between, somewhere here, clarity is more. Okay. So the most important point, if stock opens above yesterday's high, it's very much likely that it can sustain at yesterday's high and then it starts going up. I will like to take a trade. If it opens above yesterday's high and flies, I will never take a trade. Right? Because when it opens and green candle, I'm not interested to take a trade. Take the trade where you know your stop loss. If you take a green candle, you buy over here, right? You do not know it will go up or not. Suddenly one red candle and starts going down. So the most important part here is let him open above yesterday's high, let him sustain at yesterday's high, and then you buy, right? That's the key of using gap up as a trade. Okay, so if yesterday's high, where we had seen yesterday selling had happened in the last 3 hours or so, whatever was the yesterday's high, large selling happened. And if suddenly market opens gap up and sustains above this gap up point, if at yesterday's high red candles were there, that means sellers were there, what will they do? They will buy and they will act as support in your direction. Suddenly when stocks open gap up, the sellers at this point, they try to break even, and that's what adds the positive push on the upside. So I never go for first move, I always go for second move. Easy to enter, easy to keep stop loss, and then take a trade, right? So this is very, very important phenomena of yesterday's high. So when things are opening in between, confusion is there, I would say bring in yesterday's high. So gap up, gap down gets easily solved using case 1. Case 2 and 3 are pretty much evenly known, or you can say easily traded. But this is very, very important where many people miss out. Many people miss out what was yesterday's high. Was selling coming from that particular high or not? If selling was coming and suddenly price opens above this, sustains above those high, it will zoom. It cannot come down. So if that is the case, let us see what will happen in the case of gap down. Pretty much the same exact replica when you're trying to go for gap down. When you try to go for gap down, again we have yesterday's close, we have DR, we have WR, or we have monthly. Sorry, all these should be support, not resistance. So you have all these support. Stock opens straight at DS. Okay, again, when we see over here, it might go up, might go down, let him sustain around this DS, and then you take the decision. So idea here is reversal or trend, both trade are possible. Stock opens hugely, gap down, chances are more bright that reversal trade will give us more risk reward. Okay, so huge down, we are looking for reversal. DS, again we are looking for reversal, we can even look for trend on the downside. Let's say if it opens somewhere in between. When it opens somewhere in between, we need to now decide to bring in a new element called as yesterday's high and yesterday's low. So if I tell you that yesterday's low, so if I draw yesterday's picture over here, price went down, suddenly it closed over here. And this was yesterday's low. So what has happened in this yesterday's low? Buying has been seen throughout and it closed over here. Now, suddenly when the market opens gap down, right? So market is yesterday close is somewhere over here, and then market opens gap down, and it is opening in this vicinity where yesterday close and yesterday low. So yesterday close zoomed up. This was the base. It opened over here. That means all the buyers who are over here, they will become active. And here, if I get a structure, in this case where it is opening over here, and if I get a structure where the reversal is easily obtained, because yesterday we saw the bounce from here, and that's where the buyer can come in. Now let's talk the reverse way. If the gap down opening opens over here, what does that mean? If the gap down opening straight opens below yesterday's close, below yesterday's low, yesterday's close below this, and below yesterday's low, where buying has happened, if suddenly it opens here, even if it starts coming up, it will be sold because all the buyers will exit their position and the price will go further down. So idea is pretty clear. When I'm trying to see this pricing opening below yesterday's low, and if there was a sharp recovery or buying seen over here, price opening below this will have more push on the downside. So what I'm trying to say in gap up or in gap down scenario, yesterday's close, yesterday's high, yesterday's low are very, very important. So not only the daily or weekly resistance, if it opens around that zone, it's very simple to understand. The most difficult is to understand small gaps and how to trade. If it is opening down at yesterday's low, kind of buying took place, some buying will happen over here. But if it opens below yesterday's low and buying has happened, it cannot go up very easily. It might face some resistance, and you should take this trade pulling the stock or index on the downside. Stock opening below yesterday's low. If majority of volume has happened around this zone of yesterday, then you will have a sharp downside over here. So in simple sense, if I want to make a summary of this, it's very simple. You should go out and look for yesterday's high and low. So one should plot yesterday's high and low. So plot yesterday's high, yesterday's close, yesterday's low. Stock opening here, 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 all these points will help you. Stock opening straight at DR or at WR or downside at support, BS and stuff is very easy to understand. But here, when it opens in the midway, then you need to understand that in midway, only these guys can guide you. What was yesterday's high? What was yesterday's low? Now tell me, if there is 2-day high over here and the stock opens above 2-day high and it sustains, what will happen? It will zoom. Okay, for 2 days he was not able to break out. Suddenly it opens gap up, comes back down, and then starts going up. You should take a trade. Okay, so idea here is more than yesterday's low. If 2-day low is also over here, fantastic. These are simple trades which one should take if you want to master gap, because the stop loss gets defined and the risk reward is in your favor, right? Do not try to trade every gap over here. So trading gap, keeping this as the reference, trading gap, keeping DR and DS as the reference, taking gap and keeping the weekly support, monthly support as the reference can become the best way to trade. So let me show you some examples of the past, okay, Nifty and Bank Nifty, where it opens gap up and gap down, and with the levels over here, how are we able to take a trade, right? So that's very, very important to understand. I have few examples for last 3 months. Gap trading Nifty, 15th of Jan. So let's just review in 5 minutes what exactly we are trying to look over here. 2-day high was over here, and why I keep saying focusing on TradeClue reason is all the levels are plotted. You do not have to put your mind. Now we can see that the last uptick, if you see over here, yesterday low was here. It opens little gap down below this important line, goes all the way down below this yesterday's low. And if the buying has come from this point and it breaches this very easily in the first 15 minutes, what do you think? It will not come back up. And even if it comes back up, just see, if it is coming back up, it will be sold. Now, when it is coming down, again, you know what is there, 2-day low. So it cannot just go one way down, because 2-day lows are over here. It might get support. So not going down, trying to again go, not going down, just went little bit. And again, what happened? Trying to go on the reverse way. So our agenda is to trade in the first 1 hour when the gap up or gap down is happening. When the gap down has happened, 2-day high was over here. That means selling has come. Okay, fine. Small gap. Okay, and not at DR. So it is in the midway. Then I bring in yesterday's uptick, which happened over here. Suddenly that is gone. It will not go up. Right. So that's the first thing. If the 5 minutes it's taken out with huge volume, it will not go up. So simple analysis needs to be placed. Same way, if I see something over here, the stock opened a little bit of gap up, or you can say Nifty opened with gap up, and it made a spike over here. Yesterday close was somewhere here. Plus you had yesterday's last support line. If you see, the fall came, it went up, the fall came, it went up and closed. So if the price is not going below this, how do you know? Because of the spike. Small gap up, tried to test, did not, with good green candle. Now we know it can go further towards DR. Now this is what I'm trying to say. When it reaches from point A to point B to DR, just see what's happening. Suddenly after green candles, it starts going sideways. And when it starts going sideways, there is no momentum sustaining above DR. It starts going below DR zone. So if you see this candle, it's below the DR zone. This entire zone of consolidation, small candle below this, one should take a trade. And if it goes up fast, it will come down fast. This is why I'm trying to say, when the gaps happen, they zoom up, try to look for reversals at the top or the reverse way if it is opening gap down and going down. Okay, let's see this over here, the same stuff, spike getting made, previous time buying happened was the last half an hour, or you can say last 1 hour, and suddenly the same spike was made, and along with this the max pain was there. So technical kind of support was here, spike was made, max pain was here, trying to go up, selling came because of the max call OI. But after that max call OI, still it started reversing, and just see sharp uptick came because of little bit of unwinding at this end. It comes back over here. Since the selling has come, the sellers become buyer, and then it starts going higher towards the DR zone. So what we are trying to look over here, the same agenda, spike trying to test the last 1 hour support zone, and then it goes upway, spike towards the last 1 hour support zone, trying to go on the upway. Over here, yesterday's move was up move, so that means I'm assuming that market has opened on the upside and the strength has been maintained. After the big up move, suddenly stock opens gap up and starts going into which range? DR and MR, monthly resistance, daily resistance, tries to go up but does not. You have one red candle taking out today's open. This red candle takes out today's open and then successfully comes to yesterday's close, right? So when stocks open hugely gap up in important resistance zone, wait for things to settle, consolidation if it is being breached, and then the open has been taken out. Just see what happens. Each candle trying to go up, not able to go above today's open, and then final downside comes in. So simple way to understand. The clarity can come to trade gaps only if you try to see at important zones. Do not try to trade every time. Try to see when things are making sense. Last uptick happened, closed over here, opens up, zooms up, comes towards 2-day high. Did not sustain, starts going down. If you see, this was the open, coming almost down, sustaining on the sideline, again coming back down. Good consolidation has been broken by one red candle. This is the open. Once the open has been out, just see the fall, right? So this where huge opening and strong buying has happened. Suddenly, when the price starts going below this, the fall comes faster. The same buyers can now exit, and because of that, it moves fast down. Same way over here, when we were seeing that price was trying to go down over here to the open, did not, spike came, tried to go higher, did not. Later after this, a complete red sell. That means wherever the buyers were there, they are not able to now gather momentum. And then the price is sustaining below the open. Here, if you see, finally it gives way. So whenever stock opens gap up, usually in the resistance zone, try to look for these kind of reversal trade. Let them consolidate at the higher level. Try to see where the open is there. Try to see if the buyers have bought or not. So here, two green candle, buyers have bought. Buyers have bought. More buyers buying. This will help us to reach faster on the downside. More buyers buying will help us to reach more faster on the downside. So this is very, very important to understand. Same way, now we know that hugely gap down, spike was made, sustaining on the downside, doesn't go below this, kind of reversal happening. This is very, very important. When now the reversal is happening from the max put OI, if it is coming up, now all these were acting like support. If you see yesterday's close was here, all these lines before the market opens were acting like support. Because of that, the lines are in green color. Whenever you see anything in green color, that means they were acting like support. But the stock opens usually gap down. When it opens gap down and tries to now go up, one line, two line, three line, four line, all this will act like resistance. So if it sharply goes up after the gap down, if you are able to catch this trade, very good. If you are not able to catch, no problem. After huge gap down, when it starts going up, start looking for sell. So it starts making a spike over here, coming back down, going sideways below this resistance zone, because now the support becomes resistance and the sharp fall. So this is what you need to understand. If you miss out a train on upside, but then these resistance will act, the support will act now as resistance. Please understand, 2-day low. If stock opens below 2-day low and comes back over here, that means all the buyers at 2-day low will act like sellers and the price doesn't move very fast on the upside. So that is one more important point which one has to understand. Sharp fall, tries to go up, goes sideways, and if you see over here, this was the open, trying to punch on the downside, goes down almost to yesterday's close, trying to sustain, goes down towards yesterday's close, and then reverse. This is why I was saying when the markets or stock opens gap up, tries to come back down, yesterday close will act like support. Unless yesterday close is not breached, it cannot go down. Usually gap down, coming down towards important weekly support levels. When it comes to weekly support levels, then we start looking for what? Reversal. So I've said whenever you have good gap down opening, then we look for reversals. So huge gap down, act like reversal. Mentally you should be prepared to start picking for reversal trade. Bank Nifty opening up, zooming up, going higher, 2-day high. That means previous 2-day high is over here, starts coming back down, back down. Now it's going below the open, straight to yesterday's close. And yesterday's close will act like support, waits. Now finally he has breached yesterday's close. Tries to come back up, nothing happens, keeps going down. Once the yesterday close is breached, they was acting like support. Once it is breached, they act like resistance. So yesterday close is very, very important. Same thing, zoomed up, gap down bullish, trying to go up again. Good green bar, buyers have come in. They have entered into a good resistance zone. Max pain, DR, max call OI, everything is over in this zone. Then you have a sudden consolidation sideways, breakdown over here, where it breaks the buying part over here, the buying part over here with a good red candle, keeps going down. When it comes back down, it has come to open. When it comes to open, I said yesterday close and open, they will act like support, trying to go up. One red candle, this is now been breached, further downside. These are the trades which we want to make. From DR to DS are the best trades that you can make. Selling at DR and buying at DS. Right? So that's very, very important. Again, spike was made at the bottom, zoomed up, 1, 2, 3, 4. Resistance is there, comes back down. Again, buying comes in, starts going sideways, good red candle, and then it starts going down. When it comes towards yesterday close, as we know now it has come over here, it will take some bounce. So when it starts recovering, either you can square off your position, like over here, it started recovering from yesterday's close, but then further downside happened. So whenever you sell over here, square off half of your position and then you can trail the remaining half for the downside. If you have sold over here, square off your position near yesterday's close, and if it goes below this, then half of your position is open for further downside. So you need to do little trade management. Huge gap up, trying to go above. This was above DR, sustaining. One more line was at the top. Suddenly, good red candle, breaching everything. Sustains below this, sharp fall on the downside. So always wait. Do not try to enter anywhere and then take a trade. So wait for it. Let the consolidation zone or important resistance zone is there. I'm looking for breakout, not on the upside, but on the downside. So breakdown is very easily possible, but the consolidation has to be reached. So these were some of the examples. There are a lot. Okay, so this is like 3 months analysis that we have done just to showcase the last 3 months because a lot of volatility was there in the market. But if you go out in general to trade gap, this is the best format to focus on. If stock is opening gap up or index is opening gap up or gap down, try to bring in yesterday's high, yesterday's low. What has happened in that zone? Buying has happened on yesterday's low or selling has happened on yesterday's high. Has the stock opened at DR or at support? Stock open at weekly resistance or at weekly support. So when you're trying to see these levels and then play a gap, then it becomes very, very fruitful. Please do not forget something called as yesterday's close. This is the decider because if the price goes down below yesterday close, the closing is called as negative percentage closing. If the price goes up above yesterday close, then we say it has positively closed today. So yesterday close is a decider candle, right? So thank you very much for attending this second webinar of TradeClue. We'll keep bringing the same seminars along the way in the next week as well. So all the description of the gap would be given at the bottom of the YouTube channel. Plus, if you want to get the link to register into TradeClue, that's also given over there. So do check it out and be tuned. Have a good weekend, and then we'll meet again in the next webinar session next week. Thank you very much.